Today I'm going to try to make a video that I tried to make 3 times yesterday and just it didn't work out, so I just deleted them. And during the day I had like 4 or 5 commentators ask me what I thought about exactly what I was trying to make the video on. So here we go. So the first thing I want to say is, look, the way I look at the market is I want to understand if there's any stress in the market. And a lot of times we can't see this when we're talking about the financial plumbing. In fact, I would argue most of the time we don't see it until we see the reaction of the regulators or the government when they come up with a facility, what kind of facility it is, what kind of liquidity it is, how big it is. All these things add up to tell us, are we really under stress, okay? So we all know that Basent went to Japan about 4 or 5 weeks ago, and I think everyone thought he was going there for trade, but the announcement that came out was that America and Japan, the BOJ and the Fed, had signed a currency swap agreement. In other words, you can swap the yen for the dollar. And thereby, we learn that there's stress in the Japanese financial system. And what kind of stress is it? And how big is it, right? So real quickly, here is a description of a currency swap between Japan and the Fed. And the only thing I'll say, and there's 2 pages here, the only thing I'm going to say is a swap is designed that it's not supporting or driving down either of the currencies. That's not what this is for. This is a liquidity facility that the Fed is helping the BOJ get dollars to the institutions in Japan. So now we want to understand why they want to get dollars to the institutions in Japan. And so here's the second page of this. And you can see at the top, they say they pay a fee. We did a video, several actually, on the great financial crisis when the Fed went in and we saved Europe. And what we did is we normally charge the BOJ 50 basis points, but for Europe, we cut it down to 25 bips because we're during the great financial crisis. And then we gave them all the dollars for their banks to meet their margin calls. And so this is really what we're looking at here. So I haven't seen anything different, so I'm assuming that it's 50 basis points, but I definitely could be wrong. So here's a report that we've had a total of 25 liquidity events with the BOJ, with their institutions, since Basent went there and cut the currency swap deal, because that's how much dollars that the Japanese institutions need. And so, why do they need liquidity now? Well, here's the JGB 30-year. And as you can see, if you were an institution in Japan and you bought all your bonds, or a lot of your bonds, in 2015, 16, 17, 18, 19, all the way up to almost 23, guess what? Actually, all the way up, you're way down. So we see all the reports all the time that the U.S. banking system has over $400 billion in hold-to-maturity portfolios, losses, okay? Remember something, they're only in the hold-to-maturity portfolios. There's plenty more losses. It's just there, okay? And then you also look at the 10-year, the same thing. I mean, it was down about 0.25% for 5 or 6 or 7 years. All those bonds bought today, when the bonds are at 160, they're down big. Now, when you look at the Japanese currency, you're starting to see that we just don't know which way it's going to go. Because the Japanese said they're not going to be raising their interest rates until at least 2026, when Yudida had said before, I'm going to raise the interest rates and normalize them. That's why Yudida was brought in. Remember, we talked about that in several videos? His whole thing is to normalize the interest rate structure in Japan. So for the first time in years, the BOJ bottom rate is 25 basis points. For 23 years, it was 0 to negative. Think of that. So now they're at 25 basis points. So the BOJ knows that their insurance companies, especially the insurance companies in Japan and their banks, hold a lot of paper that is underwater, okay? And we also know from the yen carry trade, what they do is they borrow all the money out of the JGB and go overseas and get higher yields or buy into the stock market in America or wherever they want, right? They can go anywhere they want. So there's all kinds of carry trades, but that's what it is. But notice what's happened here. The Japan Securities Clearing Corp has increased initial margins on long position of equity indexes by 60 to 80%. The margin isn't 60 to 80%. Whatever the margin was before, it's now up 60 to 80%. And notice short position in Japanese government bonds increased by 43%. Okay, so if your margin requirements were 10%, they're now 14.3. Okay, that's what that means. I don't know what they were, but whatever they were, they're up 43%. This is the Japanese government trying to control a very bad situation, all right? So then you say, so what does the currency swap primarily serve? It's a stability mechanism. And they say right here, notice the number 2 here, stabilization effect. It's not directional force. They don't care. They're not doing this to either drive the yen up or the dollar down. They're doing this for liquidity in the Japanese system. So here's the deal on that. The world, the financial world, is run in dollars, okay? So it actually doesn't matter that you start in Japan, you buy JGBs, you borrow the money, and you go overseas. As soon as you leave Japan, what are you doing? You're taking your yen that you just borrowed out of the JGB, and you buy dollar-denominated assets, okay? Or you're buying dollar-denominated assets in Europe or East Asia. Doesn't matter, right? Everyone deals in the dollar, okay? We're not talking about financial transactions where the dollar is around 55% of all the transactions. We're talking about asset management, and that is done in US dollars. So here are the institutions, and their JGBs are underwater, but they're getting margin calls. So what do? And they're leveraged to the hilt. Remember something, the yen carry trade, as we said many times, picking up nickels and pennies in front of a steamroller. And what does that mean to us? Well, we did a video one time, we showed some expert, and they said that, look, even though they're picking up basis points, just basis points in the carry trade, they lever up so much that they're actually making 9%. So they're levered up between 50 and 150 times. 50 to 150 times. So if they sell, it would be devastating, right? Because they would have to sell their US stocks, bring the money back, okay? And that would mean selling the dollar and buying the JGBs, which everyone's for, especially the Americans are for that, but it would sink all the Japanese institutions, and that they don't want to happen. And so you saw Percent last week come out and say that Japan is behind the curve. They need to raise their interest rates to fight inflation, which is a crack up coming from a guy who we just came in at 4.2% core inflation, and he says that we should cut the interest rates by 1.5 to 175 down to 3.25%. And our inflation rate's a percent higher. I don't get it. So we do know that Japan is stressed out of their minds, and they've had 25 interventions. So what are they doing? They're saying, give us your Japanese securities, okay? And you can do, as we pointed out before, that you can put them together. So you can put CMBS, JGBs, you can put corporate bonds, you can put everything together, and we will lend you dollars against it so you can go fulfill your margin calls. So how long can they continue? We don't know. Is one institution go, then the rest follow? Again, we don't know. The only question we want to answer is the market under stress? Yes. Is there a facility in place? Yes. Is it big? Yes. Like and follow.